First of all, I want to welcome everyone to the lectures, Economics Prize Lectures for 2013. My name is Per Strömberg. I'm a member of the Prize Committee for the Economics Prize. And this year's prize, we've awarded empirical research in asset pricing or finance, which deals with to what extent you can predict future price movements of financial assets like stocks, bonds, or real estate. Turns out that this notion of predictability is a very important test for how well markets work, and we really want these financial markets to work well because they decide, that they have a big impact on the way firms and investors will allocate resources in the economy. We have three laureates. If I start with Eugene Fama from University of Chicago, basically started this literature in the 1960s and looked at to what extent prices could be predictable in the short run. And it turns out that if the markets work well, if prices are right in financial markets, it should be very hard or impossible to predict future price movements. And the research that Eugene Fama did pretty much confirmed this. It was extremely hard to predict prices in the short run. Now, in 1980, or around 1980, Robert Shillers started studying predictability over longer horizons and volatility of financial prices, asset prices over the longer run. And it turned out there you could actually get a fair amount of predictability in prices over those horizons. Now the question was then, is this a sign that markets are not working well, or could there be something else going on, for example, that the risk preferences of investors change over time? Now, it turns out it's very hard to test these models, and here Lars Hansen did some path-breaking research in developing methodologies to test these complex models, and also made some very important tests of the standard models and rejected them. And the research of these three laureates have led to incredibly rich literature in finance, taking various paths, some working with more rational models of investors, some working with behavior models and market frictions. And thanks to them, we know a lot more about how financial markets work than we did before. So with this little introduction, I'd like to call our first speaker up, which is Eugene Fama. Gene was born in 1939 in Boston, and he spent 50 years, pretty much exactly, at the University of Chicago as a PhD student and as a professor. And he's currently the Robert McCormick Distinguished Service Professor of Finance at the Booth School of Business. Please, Gene.
Thank you, Per. Thank you all for coming. And I go back to when this was really starting. In 1962 was a really propitious time for PhD research at the University of Chicago. Computers were coming into their own, liberating econometricians from their mechanical calculators. It became possible to process large amounts of data quickly. Stock prices are among the most accessible data, and there was lots of interest in studying the behavior of stock returns, primarily at the University of Chicago and MIT. It was clear from the beginning that the central question is whether asset prices reflect all available information, what I labeled the efficient markets hypothesis. The difficulty is making the hypothesis testable. We can't test whether the market does what it is supposed to do unless we specify what it is supposed to do. In other words, we need an asset pricing model, a model that specifies the characteristics of expected asset returns in a market equilibrium. Tests of efficiency basically test whether the properties of expected return implied by the assumed model of market equilibrium are observed in actual returns. If the tests reject, we don't know whether the problem is an inefficient market or a bad model of market equilibrium. This is the joint hypothesis problem that I emphasized in my 1970 Journal of Finance paper. The second part of this section on capital markets is about event studies. So in the initial empirical work on market efficiency, the test centered on predicting returns using past returns. In a 1969 paper that I co-authored with Larry Fisher, Mike Jensen, and Richard Rowe, extends the test to the adjustment of stock prices to the announcements of corporate events. In the FFJR, the event is stock splits. But the impact of the paper, the long-term impact of the paper, traces to the empirical approach it uses to aggregate the information about price adjustment in a large sample of events. Like other corporate events, the sample of splits is spread over a long time period, in this case 1926 to 1960. To abstract from general market effects that can obscure a stock's response to a split, we use a simple market model time series regression. That's this little equation here. So in this equation, RIT is the return on a stock that splits its shares, not necessarily a month T, but this is just the return on a stock. This is a constant, this is a constant, this is the market return, and this is a residual. Now what these two terms pick up is the average return on the stock and its normal response to the market. Everything else goes into this term. So the effect into the residual term. So the effect of the split on the return shows up in the residual. And the tests focus on examining the properties of those residuals. Now the cute little insight that we had was if you really want to aggregate this information across all of the stocks that experience a split, you change the way you measure time. So you measure time relative to the event. So time 0, we only had monthly data at this point. Time 0 is the month when the split occurs. Time -1 is the month before that. Time +1 is the following month, and so on. So what we did was we averaged these residuals across, I think there were 670 splits, in event time. So we get the average residuals, 30 months, we went to -30 to +30, from 30 months before the event to 30 months after the event. And we looked at those average residuals, and we also examined the cumulative average residuals. So we just cumulate that series of averages. Let me put up the. So this is this is the striking picture that emerged from that study. This is the plot of the cumulative average residuals from 30 months before the split. This is the split month here, and this is up 30 months after the split. And these are averaged across all of the 670 companies that did stock splits in this time period. So you see this is the path of what happens in advance of the split. So you see this cumulative going straight up. So what it says quite obviously is that companies split their stocks after they've experienced good times. And that's easily documentable in terms of dividends, earnings, and that stuff. Now it looks like you can make money on this. Well, you could make money on it if somebody told you the split was going to occur. That would be really valuable information. But you don't know that until it's announced, and it's not announced until very near the event. But what market efficiency says is all the information that implies should get into the price at the time when the information comes out, which is time 0, and thereafter it should be just random. And that's exactly what you observe here. This is incredibly flat after the... So there's no more price adjustment, despite the fact that 75% of these companies continue to have good times in the years after the split. A little aside here, when we submitted this paper to a journal and it came back with a referee's report that said, "This is great, just publish it." That never happened again in my entire history, that they didn't request any rewrites of the paper. Now this paper, I'm bragging unashamedly here. This paper spawned an event study industry. I mean, there have literally been thousands of people that have studied different events to look at how prices adjust to the announcements of specific kinds of events. Finance journals are filled with them. This really was the paper that launched serious academic research in accounting. It was for a long time the most highly cited paper in accounting, and I'm not an accountant. So Now, the next topic is time-varying expected stock returns. Early work on market efficiency generally assumes that equilibrium expected stock returns are constant through time. This is unlikely to be true. The expected return on a stock contains compensation for bearing the risk of the return. Both the risk and the willingness of investors to bear the risk are likely to change through time, leading to a time-varying expected return. The trick is to find predetermined variables that can be used to track expected returns in forecasting regressions. The stock's price is the present value of the stream of expected future dividend, where the discount rate is approximately the expected stock return. Thus, a high stock price relative to dividends is likely to signal a lower expected return, and vice versa. The word likely is needed because the price also depends on expected future dividends, which means the dividend yield is a noisy proxy for the expected stock return, a problem that Bob Shiller and John Campbell emphasized early on. Efficient market types like me judge that the predictable variation in expected returns on stocks and bonds is rational, the result of variation in risk or willingness to bear risk. In contrast, behaviorists argue that much of the predictability is due to irrational swings of prices away from fundamental values. In a 1989 paper, Ken French and I again addressed this issue. We find that the expected returns on stocks and bonds move together, and the variation in expected returns is related to business conditions. The general result is that expected returns are high when business conditions are poor and low when they are strong. In a famous 1981 paper, Robert Shiller finds that the volatility of stock prices is higher than can be explained by the uncertain evolution of expectations about future dividends. This result implies that much of the volatility of stock prices is from time-varying expected returns. The market efficiency issue then is whether the variation in expected returns necessary to explain Shiller's results is beyond explanation by a model for rational expected returns. It is certainly possible to develop models for rational expected returns that produce this conclusion. But then we face the joint hypothesis problem. Do the tests fail because the market is inefficient or because we have the wrong model for rational expected returns? Okay, so now we come to actually the topic that I've spent more of my time on. This is asset pricing models, developing and testing asset pricing models. The first paper that I did goes back in 1973 with Jim Macbeth. The first formal model of market equilibrium is the capital asset pricing model, the CAPM, of Sharpe and Lintner. In this model, market beta, the slope and the regression of an asset's return on the market return, is the only relevant measure of an asset's risk, and the cross-section of expected asset returns depends only on the cross-section of asset betas. Now, the early evidence on the CAPM was generally favorable, but the golden age of the model didn't last that long. In the 1980s, violations labeled anomalies began to surface. Bonds finds that market beta does not fully explain the higher average returns of small stocks. There are other papers that show that the earnings price ratio adds to the explanation of returns that's not captured by beta. Book to market ratios is the same thing. Now, these came out in a series of papers that looked at one of these anomalies at a time. And viewed one at a time in the papers that discovered them, the CAPM anomalies seemed like curiosity items that show that the CAPM is just a model and can't be expected to explain the entire cross-section of expected returns. And then in a 1992 paper with Ken French, we examined all the common anomalies together. Now, apparently seeing everything in one place led readers to accept our conclusion that the CAPM just doesn't work. The model is an elegantly simple and intuitively appealing tour de force that lays the foundations of asset pricing theory, but its major prediction that market beta suffices to explain the cross-section of expected returns seem to be violated. This is the model that Ken French and I proposed to replace the capital asset pricing model. It's the so-called three-factor model. So what we did is we added to the market beta here, we added a second variable, small minus big. The difference between the return on a diversified portfolio of small stocks and big stocks, and HML, the difference between the returns on diversified portfolios of high and low book-to-market stocks. Ken and I have many papers that address the empirical robustness of this model. Now, it's a model. It doesn't work perfectly by far, but it works a lot better than the CAPM. Whoa, 1 minute, okay. So I have to explain 7 years of work now in 1 minute. So time is really getting close. Well, this model has become kind of the bogey that everyone in asset pricing tries to knock down when they have a new asset pricing model.